Hey, let me ask you something. How are your investments doing? The S&P 500 is up 22% from its low point, which was this day 1 year ago. Overall in 2022, it lost about 18%. I bring that up because we're going to be talking about investments tonight with big, no, huge portfolios. The Oregon PERS Fund. It was down last year too, and that might have implications for Oregon taxpayers. It's our big story tonight. That Public Employee Retirement System Fund, also known as PERS, is massive. It's roughly $103 billion, give or take on any particular day. It's partly funded by your tax dollars when you pay for schools and other government services. But last year, the PERS investments overall lost money. And it's unfunded liability, meaning the amount of money it has versus what it would have to pay out if every worker covered by the fund retired today, which of course won't happen. Well, that amount is short by roughly $28 billion. And you should care about that because if you pay Oregon taxes, you'll likely be paying more to support that fund next year. That was revealed a couple of weeks ago at this regular meeting of the PERS board. The person speaking in the light-colored coat is Matt Larrabee. He's an expert in pension and retiree programs sponsored by governments. He works for the consulting firm Milliman, which helps PERS with its fund.
2022 calendar year was not a great year in the investment markets for PERS or for any other system. We had a return of between -1.5% and -2%.
Yeah, that's fancy speak for we lost money. And since the fund lost money, the unfunded liability grew by $8 billion to that total of $28 billion. The reason that concerns you is there's only two ways to get that number back up to zero. Either increase the taxes to kick more money into the funds or figure out a way to get better investment returns. But should we be worried about that dismal return last year? Well, Oregon State Treasurer Tobias Reid, who is now running for Secretary of State, says yes, and at the same time, no.
Well, no one would ever be excited about losing money, but I think it's important to think about what happened in that year and to place this all in a little bit of context. So let's go back into that year and think about all the things that we were all reading about. Really high inflation, interest rates on the rise, commodities, a simmering war in the Ukraine. So it created a really volatile environment for investing in the world, and that's the world in which we operate. But 1% does stand up pretty well against some of the alternatives. So imagine a portfolio that is a very plain vanilla 70% stocks, 30% bonds. We use that to compare sometimes. That portfolio would be down about 16% in that same period of time. Or look at two other pension funds that are really well regarded and really well run. The state of Wisconsin was down 11% plus. CalPERS, the California Public Employee Retirement System, was down over 6%. So in that context, again, we're not happy about 1% down, but 1% is a lot better than some of those alternatives. The other key point is to think about timeframes. We are a lot less concerned about 1 year than we are about long-term averages because our obligations to retirees extend way out into the future.
All right, some interesting context there. Reid points out that the returns over the last 10 years and the last 20 years are up more than 8%. As to the question of whether we should worry about the system going broke, Reid says no, it's not going to go broke. And he expects it could break even in the next 30 years. In part because there's going to be fewer Tier 1 retirees getting benefits.
The bulk of that unfunded liability is associated with what's known as Tier 1, a structure that existed up until 1996 for new entrants. Since then, the design of the program, which is set by the legislature, not by Treasury, changed, and the system is much better funded in Tier 2 and Tier 3. So that continuation of demographic trends will go on, and the funded status on current projections and assumptions improves over time.
Okay, so to say that in English, what you're saying is Tier 1 retirees are very expensive.
Yes.
And over time, there's going to be fewer and fewer of those because
Yes.
of actuarial tables and people are not going to keep living.
Yes.
And so that expense drops away.
That's
and
right.
the other people that are coming behind are not as expensive.
That's right. They're in a different system that is structured very differently.
At the same time, you expect the investments to continue to grow and the entire pie to get bigger.
That's right. You're very good at translating this.
Well, thank you very much. Of course, all of that comes with the disclaimer that markets fluctuate and world events could impact the markets as well. And then there's the future cost of state employment contracts. For example, this past summer, Governor Kotek approved a new contract deals with both of the state's largest unions. 22,000 state workers represented by the Oregon union SEIU 503 got 6.5% cost of living raise for this current year, another 6.5% cost of living raise for next year. On top of that, workers are eligible for step increases as they advance at their jobs. In addition to the state paid out a lump sum bonus of $1,500 to each union member. The other biggest union in the state is AFSCME. It's negotiated a similar package for its state workers, according to the Treasurer's Office. Those two contracts added about $1 billion to the PERS unfunded liability. Well, we'd love to hear your thoughts about all of this. Are you part of PERS? Do you have concerns about the investments losing money last year? Or did the Treasurer's comments help calm you down? Email us, will you? The address is thestory@kgw.com or call and leave a voicemail. Our phone number is 503-226-5090.